Let's start off with the point that David Gracie made really about the fact that whether we will be seeing an interest rate cut in South Africa or not, it really depends on the inflation outlook. And Governor Jill Marcus has said that we could see a low point of 4.9% in the third quarter and will average around 5.4% in 2011. Do you think that's overly optimistic?
I think it's premature to be looking at another interest rate cut at this point. I think people were surprised, obviously, that we had a cut last week. It's a double-edged sword, though, because borrowers obviously are in a position where it's cheaper to borrow money at this point in time, but are still over-indebted. Investors, on the other hand, are in a position where essentially their returns are below what inflation is at this point in time.
Looking at that low point of 4.9% in the third quarter, we know we've got inflationary pressures coming through, food looking relatively okay, but we are seeing price rises in other sectors of the economy. Apart from that, the Soccer World Cup is set to have an inflationary impact in South Africa. Do you think that was taken into consideration when looking at that 4.9%?
I think it probably has, but the issue is that we don't know what the knock-on effects will be from the electricity price increase. Obviously, it's not just the money that comes out at the end of the month when you pay your electricity bill, but the cost of goods in stores, etc., will increase, and so you'll find pressure on that front. I think the regulators are going to have to be quite careful over there to just make sure that they're in a position where your retailers aren't increasing prices beyond what they should be as a result of and using interest inflation as an excuse in that instance. The other thing is the fuel price levy, which obviously has gone up 50 cents per litre. I think from next month there's the speculation, and once again the knock-on effect over there. So it's a question of we don't really know what the ultimate effect will be. We know what the headline inflation impact will be at this point.
I mean, we're also going to probably be seeing hikes in from metro rail, airport taxes. You mentioned the petrol price increases as well. Municipalities are on the rise as well. So a little scary when you look at the broader picture. But at the end of the day, what impact is that going to have on the CPI basket?
Well, I suppose it remains to be seen, but you know the issue with inflation inside an economy is that there are two aspects to it. Is one, the money in the system at any point in time, and secondly, the velocity of that money. And we're not seeing consumer spend coming through just yet at this point in time. The reason for that, once again, as we mentioned, was indebtedness of the consumer. Currently, 80% of disposable income is spent on average on repaying debt. And so despite interest rates coming down, consumers are not yet in the position to start spending. We just hope that with these interest rate cuts, that the consumer finds themselves in a position where they actually start to pay off debt as opposed to take it as a cue to spend and use their credit cards once again.
Well, that brings me to my next question. I mean, you're talking about the velocity of the money and it's really not feeding through into the consumer's spending.
Sure.
Do you think this 50 basis point rate cut will have the desired effect, or do you think it's more of a psychological impact?
I think it's a psychological impact, and the issue is not so much what interest rates are doing at this point in time, it's what employment does inside the country. I think that that's the pivotal thing, and you're probably finding that the Reserve Bank is focusing more on growth in the economy, despite seeing, I think it was about 2.7% in the last quarter of last year. It's still a low number, and I think that's the concern. There's also probably political pressure that's coming through, and people are looking at growth as a factor as opposed to just inflation.
Well, let's look at that. I mean, we are constantly debating about the mandate, the Reserve Bank's mandate, whether it does include growth, but we know that they've been relatively flexible, just like every other central bank globally has been during the tough times. They have taken growth into consideration. Unemployment is still a very big factor, but down the line, do you think they're going to remain relatively flexible, or do you think they're going to be quite strict on targeting inflation?
I think they'll be quite flexible, because I think the growth mandate is obviously something that's going to come into consideration and into play going forward. Unemployment is a massive problem, and that goes into political aspects beyond just the economic. And so I think that there is pressure on the Reserve Bank, but I think they will be flexible. They will be flexible in terms of the mandate.
And growth pegged at 2.6% for this year, and that's higher than the 2% initially expected. What do you think is going to push us further from these levels? We know the strong rand has been impacting our exporters, so that's looking relatively subdued. Is it about internal growth?
I think it is about internal growth, but essentially our cue is going to come from foreign markets, our main trading partners, when we see what happens inside the European market. Obviously, I heard you guys talking about the Greek issue at this point in time. There's concern around Europe. Outside of that, what happens in China? They continue to grow at this type of level, or do they subdue it and slow it down, and what will the effect be? On the plus side is we've seen commodity prices being more buoyant, and as a result, South Africa as an economy is growing, but we are still behind the curve, I believe, because if you look, there are certain other economies that are comparable, like Australia, that are actually increasing interest rates at this point in time, when we still seem to be at the bottom, if not still going on the down cycle.
Exactly, and it's not only Australia. We saw India hiking rates. We also saw Malaysia hiking rates.
Israel, yes.
Exactly, and apart from that, we know that inflation is starting to become a little bit of a worry in those regions. And also looking at China, they got a higher than expected CPI number. I mean, it's surprised at 2.7%, and their target is 3% for the year. So they're very close to that figure. Why do you think we're seeing such a decoupling effect from the likes of South Africa, which is a commodity-linked economy, to the other commodity-linked economies, and they're hiking rates, and we're busy, lowering rates?
I think the issue around that focuses on the previous administration of the Reserve Bank. They took a very conservative line, which was a blessing at the time, but it is a double-edged sword in that we probably didn't feel the downturn as much, but the acceleration and the recovery out of it has been slower. And so we have seen the decoupling, and it'll be interesting to see if those partners help us come out of this or increase our growth rate as we go forward.
What do you think the biggest threat to the global economy is right now? Some say that we are seeing deflation being quite a big worry. Others say if we do see the stimulus in the US being pulled back, we know quantitative easing is actually set to come to an end at the end of this month, so they've got one more day to make a decision on that. I mean, sovereign defaults, the risk of a sovereign default also becoming an issue.
It will be interesting to see what they do, but our view is that they probably won't end quantitative easing so soon or just yet. And once again, there's so much money in the system, but it just doesn't have velocity at this point in time. Once you see that money moving, inflation will come back into the equation. So deflation is a short-term worry, absolutely, but in the long term, inflation is there. Outside of that, you look at the European zone, that's a concern for South Africa. It remains to be seen what the final outcome is, what Germany's stance is on Greece and on the whole European zone. But once again, it's concerning because they do constitute a major part of our trading partners.
They do constitute a large part of our trading. But apart from that, because we're seeing investors being quite risk averse to the likes of Greece and other European countries, many have said that we'll see increased flows into emerging markets because we're more fiscally sound. Do you think that's likely to happen, or do you think we could see a rise in risk aversion and money being repatriated to the likes of Europe and the US?
Well, I think it has happened in the interim. If you look at sort of the performance of your emerging markets compared to the performance of your traditional global markets, the US and Europe, there certainly has been money that's come here, and that's as a result of a near zero interest rate environment overseas. What will be interesting to see is when interest rates start to rise again, what the impact will be. The reason for that is if you look in the US context, if they increase interest rates by 50 basis points, it's a 100% increase in the cost of money. So it will be very interesting to see people who are working on the carry trade and we're happy to put money into emerging markets looking for, firstly, a high yield, secondly, the potential of capital growth. It will be interesting to see what they do when they have to start paying for the money that they've been using. South Africa, as an economy, that's one of the risks that we have. If you look at the stock exchange, probably 70 or 80 billion rand has flowed onto the JSE from foreign source in the last year. If that money were to unwind as a result of the carry trade, the impact on the currency is something that we would be quite concerned about. And once again, the impact that has on inflationary factors such as fuel and the price of imports is something that we have to consider.
Andrew, as a whole, are you feeling confident about the South African economy and the equity market as well? Do you think we're going to be seeing growth from these levels, or do you think a lot is reliant on what we'll be seeing globally?
I think our cue will come from global source, first of all. Second of all, the concern for investors is at this point is, if you look at the JSE is trading on a PE multiple of about 18, it's not cheap. So where does the value come from? So I think the markets have priced in a lot of good news on the earnings front. Whether those materialize will be an issue. And to come back to your point, I absolutely think that we'll take our cue from global source. And if Chinese growth continues, and if they put the brakes on it faster than we expect.